Good morning. Welcome to the live strategy roundtable. I am Keith Harwood here for Tradespoon. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Tradespoon and myself are not investment advisors and not registered with the SEC nor FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for educational and information purposes only and should not be considered trading advice. If either myself and or the team at Tradespoon may have a financial interest in the securities presented and the trade ideas, so please keep that in mind as you evaluate what we're discussing today. All right, so let's talk a little bit about this market strategy right now. The market just continues to grind higher. There are certainly expectations that things with Iran will work out. Headlines may be going a little bit mixed, but the expectation is that the end result will be bullish for this market. At the same time, we've started to see interest rates coming down. We've seen concerns about inflation. A lot of that's just getting disregarded because there's so much money as well going into semiconductors. This view of the AI revolution being here, being now, and being the time being right to just go all in on this stuff. And particularly off of the semiconductors, because AI consumes a lot of semiconductors. So even if the AI itself isn't necessarily profitable, the semiconductors are needed to build up that AI infrastructure. And that's certainly what seems to be driving the market more than anything. This market is in a bullish mode, overbought, a little bit scary to buy. And when it's scary to buy, there is the thought of, okay, well, how do I buy or how do I participate if I'm a little bit of afraid that we're going to get a big dip or a fall or a reversal? Well, frankly, for me, the way that gets answered is to look at shorter time frames. On the long haul, I may not be convinced that 30 or 50 days from now we're going to be higher. But every day I can wake up and say, you know what, today's another bull day, and I can capitalize on that, and I can go home flat, and I can reevaluate tomorrow and do it again, or in this case on Monday. And then if we finally get that turn, I wait for the dip to hit its lows and look to reverse course at that point. But I don't need to hold overnight risk if I'm scared about week-to-week risk. When I want to hold risk, it may be on a shorter term. Just understanding that for the next hour or the next day, this market's in bull mode, and a fundamental input could shift it, and I don't want to necessarily be exposed to that. So I've got to have my preparation for how to be positioned for overnight risk. And overnight risk is real all the time, right? We could always have a bad earnings report. We could have something escalate with Iran. And we could even have something escalate intraday. But if I have my stop set and I know my risk, I can compound my investment much more frequently on intraday trades. That's the benefit of those intraday trades. I can actually get a bigger return by compounding every single day. If I can pick up a bunch of trades for 1% that I'm holding for hours, or a day, instead of trades that I'm looking to capture 20% over the course of 2 weeks, I net out actually okay because I'm repurposing my capital. I'm in, I'm out, I'm safe. I don't have huge psychological impacts. I don't have any of these like 50% drawdowns by buying calls expecting an explosion in the stock market, or I'm not buying puts to fight against it. And taking that contrarian view can be a painful experience until it's right. And eventually it may be right. Eventually it may just decay. And if I keep buying month out puts as my exposure saying, well, sometime in the next month we'll get a dip. If it happens too late or too little, all I've done is hurt myself. So right now, I think that the approach is really focusing on shorter and shorter time frames, depending upon the confidence level. Those that are looking at the long-term story, thinking that quantum computing is going to be revolutionary in 2027. Sure, it's a completely different approach. But with the tools that we've got, I think there's a lot of ways to capitalize in the short term while waiting for the market to jump on those longer-term trades. If I want to set it and forget it, I can certainly do that. But if I want to be active and try to outperform the market, I can also do that with a lot of the tools that we've got at Tradespoon. And I appreciate the way that that's set up because right now I'm looking at them again today and there were great opportunities using some of the signals from today. All right. And again, it's all about compounding that investment. If I could figure out a way to make 0.5% every single day on my account, that would seem like a pretty aggressive move. But if I actually figured out a way to make 0.5% every single day over 252 trading days, that's 125% year for the year. That's 10x the normal market return. That's a pretty solid return. I don't really have to get 0.5% every day. I have to get 0.1% every day to still double the market return. And that's where compounding returns becomes attractive, is understanding the way to build up over time. Of course, at the same time, I have to make sure I've got cash. I'm concerned about portfolio drawdown. I don't want to go leveraged long the market, risking 10% of my account on a given day trade. I want to manage my risk appropriately and look for ways to increase my odds of success. And if I can make up a bunch of smaller return on capital trades with a high probability of success, I can avoid that portfolio drawdown. And the more trades I have that are high predicted expected value, the better I tend to do. If I load the boat with one trade that's got a 70% probability of success or an 80% probability of success, still 1 in 4, 1 in 5 times I'm going to be wrong. If I have a lot of 80% or 70% probability of success trades on, it's very unlikely that I'm going to be wrong. When I have one, there's a certainly reasonable expectation that when I'm wrong, it's going to hurt. So diversification matters. And setting the levels before I enter, being prepared, understanding, here is my entry point, here is my exit point. If I don't know my exit point for my risk, then I cannot enter the trade. First thing I have to do is define my risk and understand exactly how much I'm willing to lose and how much I will lose if wrong, even if I'm right 80% of the time. For simplicity's sake, if I'm making one trade a day and I'm right 80% of the time, one day a week I'm going to be wrong. And if I let that one wrong trade wipe out 4 days of gains, all I'm doing is spinning my wheels. So I have to define that risk well, understand that on the days I'm wrong, it's okay, it happens. Nobody has 100% success rate. But I got to keep plugging along and continuing the process. And over time, I'm going to see those returns build. And again, the more trades I've got, the more data I've got, and the more confidence I've got that my system is working. Overall, again, the market's in a bull trend, and we are seeing that trend continue. All right. 4 positions at a time is a very reasonable plan. Now, if I've got long-term positions, that may hold me back from having short-term positions. Let's say my view is that in a year, Palantir is going to be a $300 stock. If I put a bunch of money into that, I'm going to be tying up capital that I can't use for other trades. I'm going to be tying up my position count and have to reduce the number of positions I've got elsewhere. May still be the right idea. Heck, 100% in Palantir in a year would feel great. But can I do better? Can I let my own personal bias on an individual stock go and focus on the things that are moving now? And that's the goal of using a lot of these tools that we've got at Tradespoon. It's finding what's happening now, capitalize it, and move to the next trade. Don't let my underlying biases drive my trading behavior. Let the data drive the behavior, because every day the market gives an opportunity. And even if it's counter to my longer term view or my medium term view, it can be right in line with my view of the next hour. And so if I continue to change my own time horizon, I can find those bullish opportunities, even if I'm not long-term bullish for the moment, or even if I'm not short-term bullish for the moment, I may be long-term bullish. Match the market. The market right now is showing bullish, so I've got to find the time frame that matches that, and then be prepared to shift. Always be flexible. Now, when I'm looking for a longer-term view, I want to add more time to my options. When I'm looking for a short-term view, I want to stick with stock or short-term options. Stocks that I don't think are going down. I can capitalize on those with short-term put credit spreads or in the money call verticals. The trade of the week in AMD. It's a shorter term call vertical built on, yes, AMD can go up, but as long as it doesn't go down, I can get some profit off of it. And we'll come back to that AMD setup. Never sell the naked options unless I'm confident that I want to buy. want to expand on that a little bit more. If I have a view that the market is okay to dip, and in that dip I want to buy, and I am fine with holding it no matter what, then I can sell a put. But I like to treat those as cash secured puts, because if I'm not cash secured, i.e. willing to buy the stock, then I can get into margin problems. And I can end up in a panic mode and having a catastrophic scenario. So I never advocate, when I never myself sell a naked put in a stock that I don't want to own. Now, if I want to own, but only on a dip, that's a perfectly reasonable thing to do. I want to buy AMD for $450 a share. And if it gets there, I'm fine with buying it. And one put's going to tie me into $45,000 of stock at that point. If I have to account for it and I sell one put on the 450 strike and it drops, now I'm long AMD. And if it doesn't drop, then at least I collected the premium. If I go with a long-term short put, I'm tying up a lot of capital for a long time. So again, with those short options, I do tend to personally go a lot shorter time frame on them, so I'm not tying up capital for an extended period of time. If I sell a put credit spread, I've got an embedded stop in my trade and I tie up less capital. So always keep that in mind as well. We always have to be aware of these earnings dates. They are obviously crucial. They move the market. We've got a lot of stocks that have been moving pretty aggressively on earnings, particularly again in that tech sector. If I don't want to chase, I don't chase. It's usually a recipe for disaster. The AI signal is telling me continuation. That's different from chase. Chase tends to be a stock has run up. It's got a 90 RSI, and I just say, I give up. I want to be in because everybody's in. And then I'm buying at the highs. And then I'm off kilter because I say, well, I convince myself that even on a dip, I should buy more. Puts us in the wrong mind frame. I set my entry, I set my stop, I set my profit target, I execute, and I wait to see which one hits. Usually it's going to be the profit target if I've got a good system. And if I don't, if it's hitting the stop more often, then maybe it's not the system for me, or maybe I've got a flaw in there that I've got to adjust. And I can go back to my strategy and reevaluate and say, why am I only winning 30 or 40% of the time? Is it the way I'm executing? Is it because I'm buying calls instead of buying stock? Is it because I'm hedging too aggressively? Is it because I'm setting my stops too close? What is going wrong with my strategy, and how do I fix it so that I can achieve that profit? I don't like calling the bottom. I don't have the capital to move a market in the bottom. People like Warren Buffett, well, retired Warren Buffett, Berkshire Hathaway, people who become big investment houses with billions and billions and billions of dollars, they have to buy stocks when they're getting weak because they're getting an opportunity and they want that supply coming to market, supply of stocks, supply of shares. If I want to build up a position long 1 million shares, I need sellers that are actively hitting my bid. If the stock is running away and I'm trying to buy 1 million shares and there's no sellers out there, all I'm doing is paying a big premium. For most of us, we're trading much smaller amounts of capital. We're looking for opportunities where people are building that position and jumping into that same idea to capitalize maybe a smaller part of the move. Understanding that the data shows that people are building it, people are bullish, and there's upside. There's demand for the stock. Or on the other side, there's no demand for the stock. There's a lot of supply. People are selling, capitalizing on that in the short term. Again, always be flexible and review that position beta. Right now and recently, we've had a very semiconductor focused market. If all of my trades are going into semiconductors, I have a very, very strong beta to semiconductors. If I want to hedge, I need to look at tech or semiconductors. If all of my positions are in semiconductors, I'm not diversified. They're too correlated. I have to keep that in mind as I'm building out my trading plan as well. When I look at the broad market, the 10-year yield was getting scary about a week and a half ago. Got about 4.6% and looked like things were going to become a problem. Fed's going to raise interest rates. The situation in Iran is only going to get worse. And then things shifted. Interest rates started coming down. Confidence in the Fed started to improve. People went back to buying semiconductors, and the market went back into that rally mode. Where we're at now, around 4.45%, not a lot of reason for concern. If it starts to move back up, 4.55, 4.6, we start to see escalation in Iran instead of de-escalation and a potential deal for peace, maybe there's a problem at that point. But right now, the market's not telling us that there's going to be a problem. When I look at crude oil prices, they continue to drift lower, back down to 88.5. They peaked out at 105. That was when things looked like they could get worse. And now we're testing the lows of the last month or so, looking to press lower. Supply may come back to the market. The Strait of Hormuz may get resolved. And all of a sudden, things look a lot more peaceful. And there's less of that fundamental macroeconomic concern. And when I look at the other big driver of this market, of course, it's semiconductors. So semiconductors have been on a tear. And again, they dipped. When the interest rates were hitting highs, when that 10-year yield was 4.65, we had a dip. And then it went right back up as interest rates started coming down. Cheaper capital means people can invest more because they can borrow capital on debt, and we can allow for that upside scenario. High interest rates were giving people concerned about an economic downturn, less investment, and semiconductors might stop going up. They've been, again, on a tear. And it's difficult to jump on this train when it's going up this way because we've gone from 400 to 600 in about a month and a half, almost 2 months, already up 50%. Am I chasing if I buy now? Maybe. But if I buy now to sell today, or buy now to sell on Monday or Tuesday, I might just be capturing a smaller move, and I can shorten up my chart. And instead of looking at a daily chart for 6 months, maybe I'm looking at an hourly chart. The hourly chart doesn't look nearly as overbought. This chart looks much more approachable. The daily chart looks a bit scary. Looks like we're getting too overbought. Looks like we may have our upside limited. But when I shorten my time frame, I'm tightening up my stop. I'm tightening up my profit target. And I'm getting a different scenario for my trade setup. Market breadth has been starting to improve. When I look at MMFI, it's the number of stocks above the 50-day moving average. It's up to about 60%. Traditionally, full-blown bull markets, 70% or higher. So it's not where I would expect it to be with the market at highs, but it is improving. As we see another indication of this, S&Ps are trading at highs now. And RSP, the equal weighted S&P 500, instead of market cap weighted, is starting to outperform a bit, at least recently, the last week or so. A little bit more participation in this rally. So all of this said, what do I do? Well, I personally right now think shorter term is the right answer. And so when I go to the Tradespoon tools, I'm highly focused on the active traders list. Active trader gives me a lot of ideas that I can trade same day, same hour, and capture some returns. An example today, we got 3 bullish setups. Now, not all of them were executable, but we use strategy A when the market's falling, strategy B when the market's not. And right now it's not. So the focal point is strategy B. Gives me an entry point, an exit point, and a stop loss. And this morning, it opened up at, where was it? 148.99, just above the first entry point, and it dipped down in that first hour, just past that first entry point. And it's already achieved the target price. 1% return in less than 2 hours into the trading day. And I'm done. I make 1% on that one trade. Now, I'm not going to put 100% of my account in, but I'm risking 1%, and I've already achieved 1%. That trade's done. It's off my books. If I go to IGV, the entry target was 95.68. Well, unfortunately, this morning it opened up higher, and it continues to go higher. This just kept going. Didn't give me an opportunity for the entry, so I couldn't hit the target price. At this point, missed out. Model was not aggressive enough buying in this scenario, but that's okay. I already have one in APH. And then I have the third trade here, and that's in triple M, 3M. The entry point at 152.85 and the second entry for the full position at 152.09. Well, this morning, we dipped down for the full entry. We didn't hit the stop, and now we're bouncing back. And the benefit and the great thing about this two-tiered entry system is I can get into half a position that's got an equal size risk and reward, 1% to the upside, 1% to the downside. And on a little dip, I can go up to a full-size position as we get close to the stop. Now on that second tier, I'm risking 0.5% to make 1.5%. I've tilted the risk and reward in my favor. The reward is now 3 times the risk. Because the risk is getting closer to stopping out, I've got some concerns, but at the end of the day, the stock is driving back higher. It's not quite there yet, but it may hit that profit target soon. Buying in at the 2 entry points gave me some currently on paper profits if I executed it. It's not realized profit, but I still feel pretty good about it. And I'm getting close to the profit target and ready to potentially move on from that trade. Now, these are the short-term ideas, sticking with the active trader's thought process. And the market's bullish right now. So while the bearish idea I always want to have in the back of my mind, today it wasn't executable. The high was 159.70, and you can see for the short side, the first entry point was at 160. Didn't quite get there. Even though the market's up, Cincinnati Financial couldn't give any sort of bullishness. Couldn't go short the stock today. That's okay. Probably better off not being in the bear side when the market's rallying. If it shifts, I can focus on the bears at that point. But for now, the bulls are in control and the bullish ideas are still working. Buying these little dips during the day or right on the open, selling them out within that first hour or two in many cases, is generating a significant profit. And it's giving me a opportunity, just using stock, to capitalize on that opportunity to generate a 1/10 or even 1/4% type return every single day that this is working. If I am winning on 4 out of 5 trades and I'm making 2 trades a day and making, say, 0.2% on my winning days and losing 0.2% on my losing days, my net on the week is 0.6%. That's 30% a year. That's still more than double the market return. It can be leveraged with options. With this short of time frame, I usually would say better to stick with stock. Sometimes on a Friday, it can be better with options because then we have expiration that day and it already defines my risk and it gives me a little bit of leverage. But generally speaking, I'd look more towards the option, the stock position when I'm looking for only a few hours of trading. If I want to go longer term, that's where I turn back to the forecast toolbox. Forecast toolbox gives me my short-term prediction, 10-day model. The S&P 500 is actually shifting a little bit more bullish. It was looking 730 to 755. Now looks like the projection is effectively 745 to 765. When I look back at that SPY stock chart, you can see that that bullishness is coming along with that bullish money flow. 730 was a natural support here at the lows of May 19th. Now we're getting into that support being at the lows of earlier this week, Tuesday, Wednesday. Resistance up at 765 in the near term. We're about halfway between. Equal size risk and reward. And then I look to trade the more active names within the market that can generate some good returns. Now, I think a good example of one of those slightly longer term returns was AMD, the trade idea from Tuesday morning, or from Tuesday, that Vlad kicked out. The idea here is that it's showing that bullishness. The AI model liked it, right? How best to execute in this runaway bull market? Well, define the risk. First things first, we've got a bull start to the day. On Friday, the low was 461.71. Utilizing a 450, 455 call spread means I'm not going to lose money unless we go below Friday's low. So even if I'm buying higher on Tuesday or Wednesday or Thursday or even today, my risk is built upon staying above the last Friday low. If we fall below that, it's a sign that these things have changed. So even paying $4 for a $5 wide call debit spread where I'm buying the 450 call and selling the 455, I have a high probability of success here. And in this case, working the offer to try to exit at 480 means that as long as we stay here or don't fall another $60 from here, can capture that 80-cent return, 20% over the course of about a week or two. If we run higher, it can hit that profit target earlier. For those that are somewhat familiar with options or more familiar with options, it's a theta collecting strategy. It means that as time passes, I'm profiting. Using 2 in the money calls like this, it is going to collect theta. If I am bullish, I look towards out of the money. Buying a $500 call and selling a $550 call, getting some leverage. The setup here was more about the probability of success, saying that the semiconductor market is still in bull mode. Dips are being bought, even dips like Wednesday. We had a higher high and a higher low. Today we have a higher low, not yet a higher high. We'll see how things go today. And I love the way that this is setting up for just maintaining this return. 450, 455 call spread, it works. It looks like it should work. There's a low probability that it's not going to work, and it's probably actually being overpriced by the market, the probability of failure. Looking at a 450, 455 call spread, the market's basically saying there's a 15% chance that we fall below 455 by next week. That sounds too aggressive to me. Now, tell me 3 months from now, AMD is going to be above 455, and I'd say it's a coin flip. But if I'm just looking for the next week, I feel pretty confident about it. And so I like that setup that Vlad chose for this week as a result. The other thing that I like to do again is going back to that forecast toolbox and just saying, look, if I don't want to be trading these same day trades from the active trader list, I'm going to go to the company screener and I'm going to look for stocks that fit my style. And I've talked about this a lot in the morning bell and the closing bell. I don't like too much on the semiconductors right now personally. Vlad's made some good money off of them. Different people have different approaches in this market. So I'm not going to jump on Marvell, or I'm not going to jump on LRCX. But I can find a different stock, something that's maybe less correlated. Maybe I ignore the oil companies because I'm not sure exactly how things are going to play out with Iran. Maybe I'm going to avoid the AI companies. These are the things that are moving. And I'm looking for a probability of success trade, and I pick a different stock. And I just say, okay, well, Amphenol's on there. We already looked at that with Active Trader. I could pick out any of these names. Let's go to Clorox. It sounds boring. Bleach. And I just go down through the predicted stock range. I see a good model grade, a reasonable probability of the low high staying in the range. It's got a bullish tint. Should have support near the lows in the model around 95. Upside to 105, and then I can evaluate the markets with this. Or, the options markets might be prepped perfectly for a put credit spread. Easy PW, yeah, I'll pull that up for you, Renata, thank you. Easy Corp. So we've got a good model grade, high probability. I like the way the model is giving its own statistics here. The estimated move here was to the bull side. We've gone slightly below. Really, it's not showing much action for the next week. This may not be a spot where I'm expecting huge returns from a call position. Now, the vector is still positive, so it's not a problem stock. But in the short term, the upside seems relatively limited for a stock PW. Most of it is expected to see a jump up on Monday and then stability afterwards. Maybe we jump, maybe we don't. The model right now is effectively saying neutrality. The dip yesterday, probably a buying opportunity. But ultimately, again, it looks more like a put credit spread. Not that I'm expecting the stock to go way higher. Just don't think it's going to go down much more. If I want a longer hold from something like the active trader list, I could look at that APH again. It had a really good vector for today and a really good vector for the next few days. So even though APH from the active trader list, the way it was set up, was already in and out, I can combine that with the forecast toolbox and say, well, maybe I want to buy at the active trader entry, sell half at the active trader exit, and then hold a little bit based upon the forecast toolbox model and look for a move maybe up to 160 for the other half of my position. That gives me a bigger leveraged return, or a third of my position gets held for the bigger move. Or I look into the options for that bigger move, replace the stock trade with options. I maybe have financed it by already trading the stock, capitalized on the stock trade. Now I look at some options trades. There's so many ways to apply all of these tools depending upon the style that one likes. The easiest is just the in and out on active trader, right? It's short term. I'm in, I'm out, I'm done. Not thinking about it again that day. The bigger returns come from holding for bigger moves. This APH would be a prime example, right? Rather than selling it at the, what was the target high again? 150, sorry, 149.16. I think there could be another $10. Now I want to try to capture that 8, 9, 10%. All right, I'll take a percent on a portion of my position, hold the rest to see if I can get to 10% into next week. That may be worth it. And that's going to give me a better overall return than something like Clorox. If I want to be in a credit spread, Clorox, AMD, those setups worked right now. Clorox seems safer to me. AMD has a good high probability given the way the semiconductor money flow has been going. If I want to shorten it out, again, back to stock, just trade the active trader signals and enjoy the reaping the rewards. And I don't have to get 10% type returns if I'm sizing appropriately and understanding that I'm taking 1% risk so I can have bigger size than if I've got 10% risk or 20% risk in a stock. And that's the kind of risk I have to take in some of those semiconductor names, which means I have to go smaller size in order to play in that that market. All right. I think that kind of helps cover some of the stuff that I'm looking at right now. If there are any other questions, please do let me know. Otherwise, I'll let you guys go for today, but I hope that this gives a little bit of a background on how I'm looking at the active trader as the primary kind of concept, along with the forecast toolbox for me right now, given that I'm personally a little hesitant to buy into some of these semiconductor names. And that hesitation means I have to shorten my time frame in order to not feel overnight like I'm going to be worried psychologically about a problem with Iran or a problem with interest rates or a complete reversal in the money flow. And I think that's a way to help benefit my own psychological, what's the word I'm looking for, speed bump, by saying, okay, I don't have to hold it overnight. I can just take the money and then move to the next trade next time. All right. All right. Thanks again, everyone. Hope everybody has a wonderful trading day. We'll be back for another roundtable next week. And I hope many of you will be joining us for the closing bell today, or were able to join for the morning bell this morning. And if you have any other questions about any of the Tradespoon tools, you can always email us or schedule a call via this contact button right here. We got a bunch of timeframes open for next week. If you guys want to talk further about any of the tools, I'm always happy to address any concerns or questions you may have. All right. And it's slowly loading right now, but once it loads, you'll see the full calendar there. And there's always a lot of time slots here that we've got available for next week. So thanks again, everyone.